every day. So you guys can join in, tune in, say whatever you want. I'm going to give this a little bit more EMA. I'm just going over a few news articles that we had. So that's the plan for today. Drop in with whatever you guys want. It's a pretty chill Saturday. I just thought it's better that we get along. Maybe if everyone's game, you guys can come in. And we're good to go, right? Okay, let me actually see if there is a way for me to. Yeah. Yeah, so the bigger one is going to be the retaliation. I'm not sure how that happens, but if and when that happens, that's another story altogether. Right. So let's see. As of now, it looks like the EU and Canada would retaliate to the steel tariffs. In a way, that's also going to be affecting a lot of other countries that are going to not just retaliate, but also maybe halt or stall their trade talks now. That could be something that happens maybe over the weekend now. You're a tweet away from saying that, okay, that's not happening. But this time I think it's going to stick. I think the steel tariffs are not going anywhere. So don't see a reason why steel tariffs are going to be taken out. At the moment, it still looks to me like we're going to have some more amount of steel, aluminum, both have been tariffs, 50% on each, right? So you're going to get a lot of countries that are going to come out and be like, we're making deals on trust, and now you're just going your own way and doing whatever you believe is right for you. And how do we negotiate with something when you turn around and just keep changing things, right? So yeah, that's that. So let's see. If we get a lot more people, we'll keep this longer. Otherwise, we're just going to keep it a bit short as of now. I'm just going to do some of my stuff, maybe talk about a few things that I have seen in the market recently. I'm also seeing some forms of exhaustion. So most likely I will reduce my exposure, bring down some of my capital, drop it a bit. Sean, what's up? How's it going, man? It's great, bro. I'm hoping it doesn't rain because then I need to move inside. But as of now, it looks fabulous. How are you doing, Sean? All well? How's the weekend been going? Yeah, so just coming back to one of those things, what I've currently been thinking about is there are some signs of exhaustion. We are about 3% away from all-time highs. But at the same time, I'm also looking at these are also similar setups as to how bull markets happen. In order for a prolonged bull market to happen within the next month or few months, we will have to break into new highs. If we're not breaking into new highs, it's kind of going to be either choppy or we would already be heading lower. So keep that in mind. I am getting a bit cautious. I wouldn't say I'm cautious enough to sell 50% of my portfolio or 25% of my portfolio. Maybe I would take out the gains that I have made since the April lows. It's something that I have been thinking about. Maybe about 15%, 18%, 20% of the portfolio is whatever the gain has been. I might reduce my risk on that front. It's something that I'm currently thinking about. I'm going to spend this weekend, and maybe when we join again on Sunday evening for our live and talk about the whole weekend that's happened and what we look ahead for, I think most likely that would be a scenario where I would go in and maybe trigger in some of those sell positions. It's something that I'm just currently thinking a lot more about as to how these Trump trade deals happen. So I'm currently watching out for that. Let me just get over what Sean's saying. Sorry, I don't know much about what you're talking about. I'm old school. I can understand if you teach me, but it's like speaking a foreign language to me. So what we're speaking here about, Sean, and what we do every day, pretty much at the same time, 7:30 p.m. Eastern, is that we go in and analyze a few things when it comes to markets, about stock markets, the returns, the Trump tariff trades, what's happening in geopolitics, how does that affect equity portfolios, how does that affect markets, how do people make money. So that's something that's there that we currently look at. So you should subscribe and then join in, and every day pretty much at the same time. We do it at the same time, 7:30 Eastern. We get a lot of people from the States also that join in. So maybe subscribe, hit that notification, and then whenever I come online, you can come in, ask your questions. I'll answer. I'm here for about an hour and a half some days even more. So yeah, that'll be a fun thing for you to help. Come in with some questions, maybe type in a few of your stocks or type in something that you like, and then we can talk about those. Right. So let me just get over who's Shimra's Game says hello. How's it going? What part of the world are you in, and what's going on there? Sean says, I know I can learn it. There you go, Sean. Anyone can, man. Trust me, if I can, anyone can. So that's the thing. Dikshan says, good morning, my man. Good morning, bro. This was unscheduled, not supposed to be part of the schedule on a Saturday evening for most people. But I said, you know what? Let's talk about retaliations. Let's talk about vengeance on Saturday and Sunday. Let's talk about how countries might come in and do a few things that might screw up the equity market rally that we currently have. Anyway, so for all of you guys that are already there, go ahead and vote. Put in any of the stocks you want to talk about. Put in whatever you guys want to talk about. Let's do that. I don't want to keep this just me blabbering all throughout. So let me just get a few questions. So we can then have some things to talk about, maybe give a few of my thought processes as well. I do this pretty much ex tempo, so it's not like I come with a plan and I'm like, okay, we're going to talk about this. We go with the flow, we see what happens, and I'm hoping that at the end of this, even after a year, it helps a few people. That's my aim, right? I'm not here to make some money off YouTube or any of that, but whatever comes in, we put it into ads and grow the channel so we can help more people. That's the aim. Okay. So one of the things that I was honestly looking at was the retaliations that the EU and Canada would put into the steel tariffs, the aluminum tariffs. I don't think everyone's going to take it down lying easy. The thing is that I don't think anybody believes that he's bluffing now. I don't think anybody believes that he is going to go back on this 50% tariff that he's been thinking about. So I'm of the opinion that this is going to stick a little longer than most people believe it's going to, which the markets I don't think are prepared for at this given moment. So just something to keep in mind. You could have a small move lower, a pullback. If things get worse, you could have retaliations. If retaliations get worse, you can have a larger pullback. The question is, are you risking a lot more, or are you okay to sleep well at night knowing that 6 months out you're going to be okay, right? Just thoughts to ponder over. All right. You able to hear me clearly now? Is this better? Maybe I shouldn't be putting my hand over the mic. You're right. I think this should be better. Just drop into the comment saying if this is better than I. Perfect. Great. Sorry. My mistake, man. I stop realizing what I'm doing when I'm doing something. So, okay. So, those are a few things that I've been thinking about, especially this concept of reducing exposure in equity markets to a certain extent. Anything that I do hold for as a trade or as a investment from a perspective longer than a year and a half, 2 years, those don't get touched. Those kind of stocks just keep going higher, and not just necessarily keep going higher. I'm going to hold on to those because that just makes money and they compound. So, but any of my positions that have currently gone up a bit too much, or I believe is a little over the top, that is going to be something that I would maybe pair some gains on rather than lose the gains that I already have. So let me see what's Dikshan saying. Talk TTD, man. I'm super fascinated right now. So yeah, I think we did this on 3 days back on the live as well. One of the things that I'll give the trade desk is that I don't see any competitor within that field that is able to do what trade desk is doing. The benefit that trade desk has is it has massive tailwinds. It has massive backing of people shifting from broadcast television to connected TV, streaming television, right? So that's one of the biggest drivers. Is this a play for the next 1 year? Absolutely not. What you're looking at with the trade desk and its sector specific or its sector and industry in general is that there is going to be a larger story out here. There is going to be a larger total addressable market, right? TAM that we call. It is going to get larger and larger. More people are shifting to connected TV. Connected TV most likely will become like what cable was 20 years back and become the largest force. I have a feeling Trade Desk could have the largest pie in this whole game. Very well run business. I don't find better founders than Jeff Green. You know, when you have like 33 to 34 quarters of positive growth and the company keeps performing, keeps doing well, you have 1 quarter where they muffle it up a little bit, that's the time you go in and buy, usually. I think the stock's up about 55%, 60%, somewhere in that range. So people have made a lot of money all the way from the lower 40s, $50s to now, I think $74, $75. So it's a great company, very well run. Could it possibly go back to 150, 160? Quite possible it could. It could head back within the year, within next year. It's possible. Here's what happens with great companies, great founders, great management, and great total addressable market size. Is when these guys find a runway for growth, they usually make sure that they're the only ones on that field because they're so far ahead in thinking, so far ahead in their mindset that no one can even come close to that. I'll give you an example. So Trade Desk created a platform called as Kokai, Kokai, right? And a lot of companies came in, started joining it, but obviously because it's a new platform, a lot of these bigger companies, it takes time for them to, you have teething problems, or it takes time to settle down with such kind of a software. So last quarter, not the quarter they just reported, the quarter before that, there was some form of teething issues. Some of them were taking time to log in, some of them were taking time to connect their softwares with the other, with Kokai. And that did cause some form of restructuring, not just in the software, but also in the company, some form of reduction of layers of management and all that, which is all great in the longer term perspective. In the shorter term perspective, just because analysts require next quarter's earnings to be beaten, it wasn't a great scenario. That being said, what happened is after 32 to 33 quarters, they missed their guidance and they missed their EPS estimates by about a few million US dollars. Now remember, this is a $40 billion company. From what I remember, this is not I don't think it's a sub $40 billion company. I'm pretty sure it's a greater than 40 billion. My bet is this is going to be a $500 billion company in the years to come, or maybe a decade or anywhere around that. 36 billion, right? So 36, 37 billion is the market cap of the company. And a company that misses by a few million on earnings got me interested as to how is it that after 32, 33 quarters, there's two ways to look at it, right? After 32, 33 quarters, they miss on their earning estimates, they miss on their guidance, whatever happens. Stock craters all the way. It's been cratering from 140 all the way down to like 75 after earnings went down to 40. So it was a big hit for stocks, for this stock especially. So you saw it come lower, and my belief was that this guy will fix its company around and do its stuff. He was having a Meta Mark Zuckerberg type moment, right? And that was a little extraordinary for me because obviously he's not a Mark Zuckerberg in terms of what people know about, and for how many years they know about him, because Trade Desk started in 2009, and getting public was not the same time as what Facebook was. But anyways, I knew that this guy had the grit in him to turn it around. And I knew that, yes, if it's a new software and everybody does like it, there is a high retention rate, right? There's an over 98% retention rate. So if all of those things are there in the business, how is it that it is either going to become a secular headwind for the company and it's going to keep heading lower, or it will be a secular tailwind for the company from the price of the stock perspective? Because eventually these companies as well as people will realize that there is a lot more to the Trade Desk and its new platforms than just this nonsense about, oh, it missed by a few $1 million and all of that, right? So this quarter earnings came out, beaten estimates, guidance higher than analyst estimates, growth on the Kokai platform at its highest. Stock went up, I think, 20% in a day or 15%, whatever it did, right? That shows that a founder that can pivot his business so quickly can adjust to downturns very easily. Now, this necessarily might, in my belief, in a few years, if not this year already, start becoming recession proof as well. My bet is streaming is a recession proof industry. If you lose your job, you're going to sit on your couch while you don't have a job and watch Netflix. While you watch Netflix, you're going to now reduce your per month subscription from the highest level, which you were paying before, to maybe an ad version level, right? So the ads that you're going to start seeing are now going to be Trade Desk based ads, or the Trade Desk is going to be involved in some way or the other. Keep in mind, you're also going to now get some form of streaming benefits, because a lot of these guys, like, eventually, I do believe people will still continue going for their movies to the theaters and all of that. It's not like you're not going to get that, right? But what I don't actually believe in is the fact that streaming is going to take a hit, right? So it is going to eventually be a bellwether. It is going to be a scenario where people are going to spend more time. And as people spend more and more time, it is eventually going to become what I would believe is maybe the meta of streaming when it comes to digital advertisements, right? The Trade Desk is also involved with not just video, but also brand advertising on non-television based, mobile based, podcast based, any of these kind of scenarios as well. Let me just get the question from Deeksha. The YouTube CEO recently mentioned people are watching more podcasts. Maybe you mentioned overall content on TV rather than mobile. So I'll tell you what that is. If you logically think about it, spend some time and think about it. Why are people watching more podcasts? Because the news is just become absolute nonsense. Either people don't trust the news, people that watch the news have gotten bored of the news, and there is no fun in watching news anymore when you can rather watch a few people talking to you and have fun at it as well. It's better video quality, less ads, less amount of nonsense about people taking particular sides, and you get to see a lot more podcasts, right? You're not restricted to the same company having the same anchor all the time and talking to you about the same thing again and again, right? So when it's a podcast, you could watch anybody's podcast. Could be Joe Rogan's podcast, could be Theo Vaughn's podcast, could be anybody's podcast, could be goddamn us, right? But in that scenario, what happens is, the more that people start shifting from news platforms to podcast platforms, more people start spending time on watching podcasts just because they're getting their information from there. Not only is that the case, but they're also getting a lot of their viewership that comes in now through these podcasts. Ad companies are now going to focus on where the eyeballs are. That's the game, right? You go where the eyeballs are. Where are your daily active users? Where are your monthly active users? Look at a company like Reddit. Same story, right? A lot of people are writing Reddit off in this world, but they're not understanding that the growth in Reddit is not just going to come from their daily active and monthly active users that come in there and spend money in terms of advertisements and trying to get a better answer for whatever their queries are. But remember, you don't necessarily see ads only on your front page. Even when you go down sometimes and check answers for your questions, within the comments, very subtly, you'll see an ad. Reddit makes a lot of its money through ads, as well as they've started making a lot of their money through something called as other services and other revenue. What is that? A lot of people are not able to understand that. The answers that Reddit provides helps Reddit in, or especially the users provide, that helps Reddit in sending out these answers to LLMs, and they take a fee out of it. So think about it for a second. If a large part of the world starts moving towards Reddit, right? Maybe they're never going to get to the Meta and the Instagram of the world, right? Or maybe they do. Who knows, right? At the moment, they're not. They have 100 million active users. Meta's platforms have a billion. And you necessarily do not need a 300 million from Meta to come to Reddit for Reddit to make money. It's not a competitor's business. It's more people coming to this platform. So if you have 300 million people coming to Reddit, that's a 2-3x jump. And while that's happening, you're able to also move in and provide more ads. You make more ad money, you get more answers, more questions, which means LLMs look forward to taking more information from you. You make more money there as well. And what's your cost of running the whole business? It's reduced or stays the same. Very hard to increase the digital advertisement expenditure. Unless and until you're building an AI platform or an LLM platform for yourself, which these guys are not. They're an advertising business. They don't need it right now. They're not in the game like how Meta or any of the other guys are. They don't need to create their own LLM because the others are doing it. These guys are providing the information that's required, right? So that is similar to what Trade Desk is. For me, Reddit and Trade Desk are pretty similar. They are both companies that have large tailwinds, large growth prospects because of their total addressable market, great founders who have been there with the company since, I think in Trade Desk perspective, it's been about 16 years. For Reddit, it's been over 20-25 years. So no reason why I don't feel comfortable with the way these guys are currently operating. No reason why I don't feel comfortable with the way that the markets will reward them for what they will be doing in the future. Yes. So let's get to the antithesis to a certain extent. There could be a scenario where if the consumer spending does reduce, if the consumer does get tightened, the purse is tightened for everyone. Your wallets are now getting a bit tight for men because they're not able to spend that much. You might pull down on digital advertising if you're a company, right? And that could affect digital advertising companies, and maybe that's why a lot of these prices have fallen for a lot of these stocks. That being said, the only way that I do believe that consumer sentiment, consumer spending, and consumer recreational spending as well for consumers is going to change will happen only when you have a few things that happen. One is you will have to start seeing the jobless rate go up, which is I mean the unemployment rate by jobless rate, right? You have to see, but before that happens, you will have to see initial jobless claims go up, all right? Here's a fascinating thing. The initial jobless claims that came out for the last week came out at about 240,000. That's at one of the highest numbers we've seen in quite a while. Let me tell you this before. If we start seeing a number over 250K, 250,000 to 255,000 on jobless claims, that might be a number that is going to start spooking the markets. The equity markets can fall. and the bond market can go up. The yields can start moving up. If the initial jobless claims also start heading higher, it is going to be a reason why the Fed cuts. As of now, I believe if everything goes okay, there's no reason for the Fed to cut. Keep in mind, if you start seeing initial jobless claims pick up, right, that's on a weekly reported number. It basically means the amount of people that are filing for a jobless benefit that the government will provide considering you don't have a job, and the claim that the government gives it to you. Now, that claim is sitting at about 240K. The claim used to be at about 220, 225, 215, 200, some places 160, 180. Those were good days. We're currently picking up to 240. Keep in mind, if we get to something of 250, 255K, you're going to start seeing markets go out of whack, because that means the consumers' spending capabilities possibly in the future will reduce, because you're seeing a lot more people now jobless, a lot more people now without benefits. And when that happens, you are going to see an unemployment rate that picks up. Or 275 to 300K on jobless claims. I mean, we're toast, bro. We're toast. It's done. We're toast. Let me actually go back and tell you, this would be fascinating for me to find out as well. If we're anywhere close to that number, where, I mean, I'm saying even if we're at 240K now, if we go up 15K, 20K more, we're toast. 275 to 300K that's going to be a bad one. I mean, yeah, so we've been at 227, 229, 228K in the month of May, all right? The end of May, we hit 240K, all right? I want to know what's happening in the June numbers, because that's going to be important. If you actually see, we've been at 241, 220, 215, 223. 275 to 300 is game over, right? I go back and see, you've not been seeing 200 and, I mean, I've seen 258 now on October 10th, 2024. But I would have to go back a really long time back to try even getting close to a 275 number. 260 somewhere around 2023. Those could be your inflation effects as well, right? 264 back there as well. Yes. So what you're saying is that it becomes a common threat for Powell and Trump to be good with each other. The thing is, bro, in all honesty, I don't believe both of them have any idea when shit's gonna hit the fan and how badly it might, right? For that matter of fact, neither of us do as well. But what I do believe, the only way the markets hold on is the time to react. How long does it take for the Fed to react? How long does it take for President Trump to react? All right. Let me give you an example. The reason in 2022 you had such a bad bear market, right? A lot of people don't look at 22 as a bear market, but I have no reason why people don't. It was a really bad bear market. But the reason why we collapsed so badly was because the Fed was a bit late to realizing that inflation is not transitory and it's collapsing in terms of people getting affected, that kind of collapsing. So they had to hike their interest rates and keep bumping it all the way up to try figuring that shit out. And that took a hit on the economy, right? So stocks cratered, went down 70, 75%. Now, when you look at it on the flip side, what you're seeing is that the Fed is saying that we currently don't have any form of data that is powerful enough for us to realize that this is something that we need to contend with, which is going to be a problem for us at the given moment. Fair enough. There's no reason for a big, huge cry at the moment. 240K is okay, right? Is 240K high compared to the average? Yeah, fair enough. It's about 225K, 230K on average, right? 10K here and there is okay. What happens if you start heading towards, let me just change my place because we have some crazy insects and flies running around. Anyways, so what happens in a scenario where you now have maybe more than 240 to 250K, all right? Can Powell and Trump maybe change a few things for themselves? Not really, right? It's too late. You've already screwed up the economy. You can't do much. What do you do in a scenario where, so look at it from this way. When Trump realized that the bond yield was beyond his control, he started moving in and started basically reducing either the tariffs or pausing the tariffs and changing the timeline of his tariffs, right? Keep in mind that if he's doing that for a scenario that is the bond yields rising, the bond yield rising during Trump's time was purely because of his tactics about tariffs and everything else. What happens if his tariffs have caused these jobless rates to go up, have caused these unemployment rates to be higher? When that happens, it's going to be very tough to reverse that, because you're not going to be able to reverse that by just changing tariffs or any of that. That's a secular shift. When that happens, you can have a really bad bear market. You could have a really bad economy for a while to come. And most people have not seen a 2 to 3 year or a 2-year bear market or even a recession. And you could start seeing that recession play out pretty well as a concept if the Trump Powell scenario doesn't, if they're not able to act with that haste and speed with which people want them to. That's the thing, right? Do I believe they will be able to? I think this time they might. That's my belief. But remember, if the Fed is cutting because the economy is slowing, that's not going to make the stock markets higher. It's not. The Fed's job is to react to the information they have and to make sure that liquidity concerns are strong. Liquidity is available in the market, while at the same time, the job market is not affected horribly. Is the job market currently looking a bit Willy Wonka at this moment, the way I put it? It is looking like. It is. So here's the thing. Initial jobless claims have been picking up. Continuing jobless claims have been picking up, which basically means that it's tougher and longer for you, that if you lose your job, it's tougher for you to get your job back or to get another job. It is just a longer time. Earlier, if it took you 2 months that you lost your job, within 2 months you could get another job. Now it might take you 6 months. That's not a strong job market. That's a weakening job market. All right. Let me see what he's saying. Would be interesting to see what these numbers were in end 2022, start 2023. I can do that for you. In the end of 2022, you're looking at the numbers at about 240K, bro. November 2023 was the high at 240K. December end was 225. January was about 190, 180. During the year, in May 11th, 2023, you started seeing something like 264K. June had one reading at 261, 262, 264 in June of 2023. By then, the markets had reversed already because the Fed had started acting. So, I'm not saying it's doomsday and the world ends if jobless claims start picking up. What I'm saying is, if jobless claims, which nobody at this moment is speaking about to that much of an extent, starts picking higher, it's a bit sticky. So, it'll be a bit of smoke, which a lot of people don't want at this moment. But just because investors don't want it doesn't mean it won't happen. So, this week's unemployment claims, next week's unemployment claims, non-farm payroll, all of these, I might say that at this moment, this week, rather than tariff news, look for the economic news. That has more bearing. That has a lot more bearing than a lot of other stuff that's currently going on when it comes to any of this pullback / reversal in stock prices that may or may not be seen. I'm not saying it's going to happen. My best guess is your best guess as well at this moment, because nobody knows. But from whatever I know, with whatever experience I have, jobless claims, unemployment rate have a larger bearing on what's happening in the market. So just keep that in mind. Let me see what is he saying. Do you think a firm long and TTD long a natural hedge? Not that we want a hedge. In all essence, bro, there is no hedge. The only hedge you have for something like a slowing market, slowing consumer, is maybe buying some gold or maybe buying treasuries to some extent. But yeah, I mean, cash is a hedge, cash is a position. A lot of people are not comfortable with that position, but there are no hedges, man. I mean, I don't know why people believe this, why people, I'm not saying you in general, I'm just saying investors in general believe that X and Y are inversely correlated, so it's a hedge. These hedges don't really work that well. And no particular stock, at least within stocks, I'm not saying like within two sectors of, not sectors, but in terms of two asset classes. I don't see hedges between two asset classes. What I see is within the same asset class, like stocks especially, because that's what we do, if shit hits the fan for the consumer, stocks crater all throughout. You're not going to get some stocks doing well and some stocks doing badly. That's not going to happen, right? All of them do badly. If you look at 2022, it would be tough to find maybe 25 companies in the S&P 500 that would be, let's say, even up in double digits, right? Exclude the utilities and exclude maybe something here and there. What's fascinating to see is, let me see what happened to Costco in 2022, right? That might be a bellwether for something that might, if that fell in 2022, that would be something that would make me also be like, okay, cool, types. Is April 2022, Costco hits 614. May 2022, Costco hits 408. All right. Look at a company like Costco, man. I mean, even in a recession or in a bad scenario, people are going to run more there, right? Stocks down about 35%. If you're looking at something like Costco down 35% in 2022 with a slowing economy, even though we didn't have a recession. So if you logically think about it, even though we didn't have a recession, Costco fell 35%. It was just the inflation that was affecting people, which caused prices to go lower. So, nothing's going to be a hedge. I mean, if a firm and trade desk, if Costco can't be a hedge to a slowing economy, it's very unlikely that high beta stocks are ever going to be a hedge. They're just going to fall 3x more. That's the story. All right, let me get the next one. Even from a mental model perspective, a hedge goes against the idea of concentration, right? That's actually a great question. I don't think I've ever been asked that. A hedge goes against the idea of concentration. Yes. What you're saying is absolutely right. It does go against the idea of concentration. But concentration does not mean 100% equities. You can have 30% of your book in cash. You can have 70% of your equity positions in 5 stocks, and that could still be a concentrated portfolio, while cash acts as a hedge against the 70%. So that is one way of thinking about it. A lot of people are not comfortable holding cash for far too long, and I do believe that. I understand that. It's something that took me time as well. It is only as powerful when stock prices go lower and your cash seems more valuable, and you start believing that you've made the right thing by sitting in cash. The thing is, you start thinking that recurring from now, I can also sit in cash because I know when to time the markets. Now, the way I look at it is, don't sit and think about timing markets. Look at the data that you get, look at the stocks that you're buying, look at the time horizon that you're in. If you're worrying about things like jobless claims and slowing consumers and all of that, those are things that obviously you should worry about because they can have systemic risks in terms of it can cause stock prices to go 50% lower from where they are. So that's not a fall that you want to see. If you do believe that there is something which is impending in terms of markets can take a hit for some reason or the other, because of a slowing consumer, because of a slowing economy, go ahead and reduce your risk. Sit on some form of cash. It is never going to kill you, never ever going to kill you to sit on some form of cash. Right. Now, you could have stocks go up 25-30% from here, and because of that, your 15% equity portfolio, 15% cash part of your portfolio would have given you a return of, let's say, would have been actually 20% worth of your portfolio, right? And you missed out on that. In the large scheme of things, you losing out on a 5 percentage point increase in your portfolio has far too less of a bearing to a 3-year CAGR return or a return on your portfolio. So compounded, would it make some form of difference? Of course it would, but that's, you need to also remember that if reduction of return is coming at the cost of you having one, better sleep at night, and two, possibly the market's coming lower and you having money to buy then, which gives you some form of margin of safety, that in essence is a hedge. A hedge does not necessarily always mean that I need to make money in an inversely proportional way to how everybody else is currently making money. Which means if stocks are going higher, I need to have something that makes me money if I'm sitting on cash, right? Or I need to be able to see that, okay, if the market's going lower, I still need to be making money, right? Considering everybody else is not, or a large proportion of people are not. Not necessary to think that way. Sometimes cash can be a good reason for you to think of things from a little longer term perspective. A lot of people think too short term when they're 100% equity oriented or 100% equity invested. Sometimes it helps in thinking a bit longer term, and cash helps you think in that way because you keep questioning the fact as to whether today is better, tomorrow is better, a week is better, and by that your time horizon increases because you're just thinking. Now, I'm not of the opinion that you should sit 100% cash or 50% cash also, because here's what happens: 90% of the time markets head up. So no reason for you to sit on cash and keep thinking that doomsday is going to arrive, when currently we're not even in that kind of a scenario. If we can get out of 50% tariffs and 145% tariffs and COVID deaths and all of that without having to deal with such a large fall at this moment, I truly don't believe that initial jobless claims and its perk higher would be the reason that you should sell 50% of your book. Should it be the reason that you sell maybe 10 or 15% of your book? Maybe. Maybe. That might be something to keep in mind. You don't want to get so, you don't want your legs so deep into the sand that when the water is taken out, you're the only one left there, and now you cannot even get out of the hole that you dug for yourself, right? Just keep that in mind, because that is something that you need to think about, because it's, say, if you have enough money on the sidelines to take care of all of your expenses for the next 2 years and deal with everything else that's there, you don't need to give a shit. You don't even need to watch this video. Just go ahead and stay invested, and then just come every day when we talk about stocks. You don't even need to worry about cash as a hedge or any of that, because you're already hedging yourself by keeping cash aside. If you are 100% equity invested, this is something for you to think about. All right. Let me get the next one. I would love to watch a video on mental models from you, bro. A Munger classic from your perspective. So let me see if I can make one this week, because there's a lot of shit happening this week in terms of the markets and everything else. So I want to be doing these lives a little longer during the weekdays. There'll be a lot more questions, a lot more people getting shit scared or shit happy. But let me try seeing, maybe this week or the weekend that's coming, I can maybe put one through. If I get some time today, I'll try doing it as well. But I'll have to spend some time, think over it. I want to do something which is not very well spoken about. I mean, a lot of people talk about inversion and all of these other things. I want to talk about a few mental models that help people make money, help people live a better life, and help people kind of analyze not just markets, but their current personal and financial well-being from a larger perspective as to how better off you are compared to the rest of the world, and then start thinking about returns. Remember one thing, if you're able to realize how blessed you are as a person in your current life, whether you make 15% returns or 18% returns is not really worrisome. In my eyes, I'm saying to each his own. I mean, I'm saying capitalism, I'll be the first guy to hold the flag for capitalism, but at the same time, I would also be a guy who would believe that I'm humble enough to know that a few percentage points here and there, that's okay with me. That's fine by me. That's not something that would be a problem for me at all, right? Yeah, so coming back to that, Tesla's registrations in France down 67.8%, 0.18% in May. Okay. I mean, I don't know if that's a Europe just going against Tesla kind of story, or is it this that they have BYD and many more options there? I mean, it'd be fun to find out, because I don't really think, I don't know how much of that is going to get affected with just because of Elon. So it's going to be fun. Nice chat, Dikshan. Take care. See you on what's it? Monday. Yeah. So I'm going to do maybe the weekend Sunday. So I'll catch up with you. Same time tomorrow. Yeah. So the EU Commission says we strongly regret the announced increase of US tariffs on steel imports. Tariff increase also undermines ongoing efforts to reach a negotiated solution. The EU is prepared to impose countermeasures, including in response to the latest US tariff increase. EU Commission spokesperson, Commission is currently finalizing consultations on expanded countermeasures. Anyway, so I wanted to keep this thing short as well. I think we're already 47 minutes in. So keep in mind, you might have a week of retaliations. You might have a week of consumer data that comes out. You might have a week of jobless data that comes out. There's a lot of economic moving factors. Don't get swayed by everything that happens. Look at it from an average perspective and then take at it. Make sure all of you guys that are not yet subscribed, go ahead and subscribe. We're going to be doing this again tomorrow and in the future as well. So it happens pretty much every day at 7:30 p.m. Eastern. Go ahead and subscribe and join in live for all the next chats that we have. And take care, guys. Enjoy your weekend. Look forward to seeing you tomorrow. Take care, guys.